Recording in progress.
Hi and good evening, everyone. I welcome you all on behalf of Union Mutual Fund. Thanks for sparing your time and attending the call. Today, we have with us our Head of Fixed Income, Mr. Parijat Agrawal. The agenda of this call today is monetary policy and the way forward. So without taking much time, I would like to hand it over to Parijat to take this forward. Parijat, over to you.
Yeah, thank you, Anurag. So today's monetary policy, which was announced today at 10 o'clock by RBI Governor, marks a change in the way the policy has been drafted in the last 2 years. It gives a different direction. So, what are the changes in this policy, and why it is a very crucial policy for to understand the way forward? I'll explain in a moment. I'll just share my slide with you all. Is it visible, Anurag?
Yeah, it's visible.
No, I want to make it full screen. Yeah, now it is visible, full screen.
Yeah, that's visible. That's visible.
Yeah. So, what were the main announcement in this policy? First, all the rates remains unchanged. That is what the monetary policy kept repo rate unchanged at 4%. It kept the marginal standing facility unchanged at 4.25%, and reverse repo remained unchanged at 3.35%. But what is crucial to understand in this policy, the RBI has introduced what is called a standing deposit facility. And what they have done, they have narrowed the corridor of liquidity adjustment facility back to the pre-COVID era, where it used to be only 50 basis points. What it means is that in case the banks wish to lend money or deposit money with RBI, they can do it at 25 basis lower, that is at 3.75%. And if they want to borrow money from RBI to manage their liquidity, they can do it at 25 basis higher than the repo rate, which is at 4.2. Now, one may ask that, what is this standing deposit facility? What it means is that this is a facility where without collateral, earlier what used to happen, that under reverse repo, whenever the money was parked with RBI, so RBI had to give some kind of security, some SLR to the banks. Basically, it used to be a repo kind of a thing. Now it is a pure deposit. So it means that without any exchange of collateral, banks can go and deposit excess surplus liquidity with RBI, for which they will get 3.75%. And in case they wish to borrow, they can go to RBI and borrow at 4.25%. So the corridor is 50 basis points. The lower one is at 375, the upper is at 425. So going forward, this 50 basis corridor would remain. If tomorrow the repo rate becomes, say, 4.5, then it would be 4.25 and 4.75, the lower band would be. So accordingly, it will continue to move. So it is linked to the repo rate. Effectively, what it means is that the reverse repo or the lower corridor of the overnight rates would shift to 375. So from 335 to 375, that is 40 bips higher. In the another point, RBI has kept the fixed rate reverse repo at 3.35. So it will remain as part of RBI's toolkit, but its operation will be at discretion of RBI for specified purposes from time to time. But the STF operations and MSF operations would continue on a regular basis. Also, to manage the liquidity on an ongoing basis, the VRRR and VRR, which RBI was doing earlier, would continue. So that's a major shift that we have seen. So that there is no more, what we call a reverse repo kind of a facility. It is more as a deposit facility. So it gives a more, it strengthens the monetary policy and gives more headroom for RBI to manage monetary policy and to manage the systemic liquidity. So another part to note is that when MPC has changed what we call is a stance, in the sense that it decided to remain accommodative, but it changed the wordings there. It says while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward. So this is a major change that in this policy which has come. What it says is that maybe the MPC is preparing the markets for withdrawal of the accommodative stance going forward. So it is a first step towards that. So that's a major shift in the policy stance. So as of now, it is accommodative, but depending upon how the inflation pans out, this accommodative stance can change. It may move to neutral, and then it may become towards tightening. So that's a major change also. In terms of liquidity, which is very, very crucial, because RBI has maintained that they will continue to support the financial markets with sufficient liquidity. But in the last 2 years, through various measures to support the economy, RBI had continued or undertaken various measures to infuse liquidity. So now today there is an overhang of liquidity in the system of upwards of 8.5 lakh crores. So now this 8.5 lakh crores needs to be withdrawn from the system in order to keep the monetary policy, say, move towards neutral or towards tightening. What RBI has said is that in this policy, that this liquidity, excess liquidity, will not be withdrawn at one go, but it would be a gradual and calibrated withdrawal, and it would be over a multi-year time frame. This means beginning from this year, it could be 1 year, 2 year, or 3 year. It depends upon how the global situation pans out. So that's what RBI said. So in a nutshell, the repo rate remains safe. The lower corridor of the overnight rates shifts by 40 basis points to 375. The upper band remains at 4/4. There is no change in that. Gradual withdrawal of liquidity over a multi-year, and the stance changes from purely accommodative, whatever it takes, to withdrawal of accommodation to ensure that inflation remains within the target, within the target of 4%, that is plus minus 2, that is within 6% going forward. So there is a major change in the stance and outlook in this policy. The other factors which MPC highlighted was on inflation and growth. Looking at the global scenario where commodity prices are touching all-time high, we have seen that crude prices had touched almost $130 a barrel. At present, it is trading at around $100 a barrel. So that is putting a lot of pressure. The price pressures have gone up because of that. Input costs have gone up. The other commodity prices are also running very high. Food prices across the global area has seen an upward pressure. So from all these angles, there is a price pressure, which is visible. So looking at that, RBI has the forecast for this year has been changed to 5.7, which last policy RBI had maintained at 4.5. So that's a major shift and from 4.5 to 5.7. So that is almost 120 basis upward revision of inflation, which we see in this policy. At the same time, because of the geopolitical situation and the impact of various sanctions, how it is going to impact, and higher inflation, it is expected that it is going to impact the growth also. So RBI has in its projection brought down the growth for the full year, the real GDP growth numbers, by 60 basis points from 7.8% to 7.2%. So what we see here is that in the near to medium term, inflation is expected to remain elevated and growth is expected to remain benign, or it may even come down from the projected numbers. So the major shift which throws in this policy is that the priorities of the MPC, which earlier used to be growth, has shifted towards inflation. So this policy is very clearly highlighting that MPC's priorities has changed to inflation and not growth. So they are going to tighten the policy going forward, keep the liquidity in the surplus liquidity in check, and take measures to control the inflation through tighter monetary policy, which is visible in this policy. Another factor to note in this policy is that in order to complete the borrowing program of the Government of India for this financial year, RBI has increased the percentage which banks keep in their HTM category, which is held till maturity, which was 22%, has been increased to 23% till 31st of March 2022. However, the RBI has given a time frame where it will be brought down to the pre-COVID era, where it used to be 19.5%. So the HTM limits would be restored from 23% to 19.5% in a phased manner starting from quarter ending June 30th, 2023. So it has already given a glide path from where it will start coming down the HTM percentage which the banks hold. So these are the major changes that we have seen in this policy. It marks a major shift in the stance and tone, and this policy is preparing the markets for a normalization and a gradual tightening and a move in policy rates that we see. If you look at this picture, which is this slide, which is about liquidity, we see that liquidity remains abundant, which even RBI is highlighting that the surplus liquidity or overhang is 8.5 lakh crores. It would be withdrawn through various measures over a period of time. So what it means is that the short-term rates, the extremely short-term rates, would continue to be anchored along the repo rates. And as and when the liquidity starts getting withdrawn, the rates will start inching up. So that's how what it means is that. Now, this is a chart which is very, very important to understand about the growth. So this is a weekly credit and deposit growth rate. And what we see is that there are signs of recovery. There is some activity which we have seen has improved. Credit growth, as the economy continues to heal, started to inch up. So we see that the recent numbers show improvement in the credit uptake. So that's a good sign for the growth of the economy, but it would put pressure on the inflationary pressures. So that's why RBI has started normalizing the ultra loose monetary policy and started towards normalizing and then towards neutral. This is our in-house is a high frequency leading indicator, which throws up the macroeconomic state. The capacity utilization has started to inch up gradually. It will still not reach to a level which was, before the COVID period, but it has started to improve, which is a healthy sign in terms of the economic growth. Consumer surveys on employment spending show some improvement, but still remains dampened overall because of the higher price pressures that we see across the which is visible in your CNG, PNG, your petroleum product prices, which actually eats away in the household savings. So that is visible there. The HFLI percentile is yet to revert to the pre-COVID era levels, but it is improving. That is a very healthy sign. Now, certain points which I would like to highlight, for that, how do we see the impact of this policy and on the rates going forward? It is very, very clear that inflationary expectations are across the globe. It is not only in India. We have seen in the US also, in the Eurozone also, and domestic economy also. The broad-based jump in global commodity prices has actually exacerbated the inflationary pressures. So the higher oil prices, your other commodity prices, and the food prices because of the war zone in the Ukraine and Russia, because they are one of the largest producers of wheat, so has put pressures on the food prices also. So that is visible everywhere, and the central bank's main role or theme has always been to control this high inflation, because that is very, very important. So that is visible, and that's one reason that why RBI has started moving towards that. So they have put inflation as the main priority today than the growth. Now, this trajectory, in fact, when RBI projected the inflation projection for this full year at 5.7, they have taken the crude oil at $100 a barrel. So now, in next 3 to 6 months, it remains at 100 or 120, or it comes down to 80, is a very, very challenging situation to project. So the inflation trajectory will depend critically upon evolving geopolitical situation. This has been highlighted by in the press conference by RBI governor, and it is very right that it is very, very difficult to project how things would look after 3 months or 6 months, or how these wars which is happening in the Europe and how it's going to impact the various economies would play out. So that would depend upon this evolving situation. The global spillovers would be there, what we have seen in the developed economies. The policy normalization is at a fast pace. So in fact, in the minutes of the Fed meeting, which came out last week, very clearly they have said they want to tighten at a fast pace. They want to run down the balance sheet, the central bank balance sheet, at a fast pace. What it means is that they want to hike the rates and tighten the monetary policy at a faster pace so that the landing is soft. What it means is that so that they could avoid any recession in the economy. Because the longer they take, the experience shows that it turns towards recession. So if they have taken a leaf out of their previous decades policy, where during 94, 98 they had tightened very fast, and the economy avoided being into any recession. So maybe that's one reason. So they are looking at that. So these global spillovers would definitely impact the domestic rate market also. Now, the yield curve that we have today, we could see it remain steep, because when you have expectations of rate hike, higher borrowing, so we could expect the yield curve to remain steep. And in fact, before the even the US Fed minutes had come out, we had seen the yield curve there had become almost flat. But in fact, at some point it had inverted. But with a faster rate hike and tighter monetary policy, we see that the steepness by 20 basis, that is between 2 year and 10 year, the steepness of 20 basis is still there today. So once it starts happening, you could see that or 10 year inching up much more than the shorter term because of sufficient liquidity in the domestic system. The fiscal deficit target of 6.4 is definitely large. The supply pressure would continue to put an upward pressure on the yields that could be there. But higher GST collection, which we saw in March, upwards of 1,40,000 crores, and would aid in some, cooling of the fiscal slippages. That is what is visible there. However, the biggest challenge that we see in the, any policy this year is the market uncertainty with the kind of escalation of the geopolitical situations, the various sanctions. One must realize that sanctions, hit both ways. It impacts the global economy also. The surge in the international crude oil and the commodity prices, the financial conditions have tightened, and supply side disruptions would take a much longer period to cool down or come back on track rather than anticipated. So these put a lot of uncertainty in terms of I would say, the inflation and growth directions. And that's why even RBI has also mentioned that the uncertainty has definitely increased after the 24th February when this war started. Another point to note here is that what we could feel or understand from this policy is that the withdrawal of accommodation and the liquidity, everything would be very, very gradual, and RBI would take sufficient time. There will not be a back-to-back, I would say, rate hike. So first, as mentioned in their last policy, they have tried to say that accommodative, but with a probability of change of stance if the inflation remains high. So obviously, the next policy we could see the stance coming neutral, and maybe after that, one can see that there could be a repo rate hike. So that would be very gradual. And as mentioned by RBI, the liquidity withdrawal would be a multi-year. So in a nutshell, move towards policy normalization. We could see a tighter policy going forward. This ultra loose policy would be gradually withdrawn, and we could see the rates to move up going forward. Now, the trajectory of rate up move will definitely depend upon the incoming data, because that has become very, very challenging to project in the near to medium term, depending upon the geopolitical situation. So based on these factors, yes, the rates are going to go up, because even today the 10-year has touched 710. It was 690.92 before the policy. So the yield curve has moved up, I would say, across the curve by 15 to 20 basis points. So that's what the impact has been of this policy. And whether there could be further up move, it is possible depending upon the incoming data. We have on 12th our CPI data. It is expected to remain elevated and upwards of 6%. So that's going to keep the rates on upward pressure. So that's what, in a nutshell, the policy that we see. Based on this policy, what are the funds that we see is going to benefit the investors in current market scenario? As I said, that the lower corridor has been shifted from 335 to 375. So for our institutional clients, liquid fund is definitely going to give them a better return. So the return in the liquid fund, any money market fund, is going to go up. Though in the immediate near term, there could be some MTM losses, but that would be taken care of as we move ahead, because the repricing would happen at a higher yield. The fund of choice continues to be our corporate bond fund, because this is the part of the curve. It still remains attractive, and And as the yields goes up, what we see is that the repricing will continue to have at a higher yield. So your accrual would continue to be at a higher yield. So one would continue to get a reasonable return compared to the other fixed income products at this juncture. The higher duration fund would continue to remain volatile and would get impacted with tighter monetary policy. So that is not recommended at this juncture. So what is recommended is that short to medium term kind of a funds at this point. So that's all about. I'll be happy to take any questions. Back to you, Anurag.
Thank you, Pari. Let me just go through the questions. Yeah, so the first question is, how will the newly announced SDF be helpful to RBI and banks?
See, SDF means that standing deposit facility. This was the demand from the market and the banks for a long time. Because what happens that ability of RBI to conduct liquidity operations was getting hindered because earlier the money withdrawal from the system was happening to reverse repos. Now, in reverse repo, when banks deposit money with or give money to RBI has to give a collateral, which is a GSEC or some STM. So now, in absence of sufficient security on RBI's books, they are constrained to do that. So now, in this, it is up to the banks the amount which they want to part with RBI. RBI has to simply take that money. They do not have to give that amount of security to banks, and they get a higher yield. So it would make it very, very convenient for banks and RBI to conduct the operation. So that is how it is going to be very, very helpful to manage the domestic liquidity.
Yeah, so the next question is, with respect to the yields on corporate bonds, how would the yields on corporate bond fund move?
See, as I mentioned, the yields have moved up by 15 to 20 basis points today across the curve. So, suppose what was 5% yesterday has moved to 5.20. So the corporate bond fund, the yields have already moved up by 20 basis points. So normally in a fixed income market, the impact is very swift, fast. So the moment RBI does anything or policy change happens, the market moves very fast and starts getting priced in very quickly. So going forward, whatever the incremental cash that we have or whatever is getting matured would be repriced at a higher yield. So your accrual would be at a higher yield, and mark-to-market losses which has happened today would get reduced. So that bit is going to help the corporate bond.
Okay, so the next question is very much related. So the first part says, what is the near-term outlook on 10-year GSEC yield? And the second one is, the second part of the question, outlook on the corporate bond market for 3 to 6 months.
Yeah. So 10-year, as I mentioned, we have already moved up by 20 basis. So if I take in another 20 basis, because, one can say that looking at this scenario, MPC is expected to hike the repo rates by 50 basis in this calendar year. So markets may not wait till the full year, for the March. So the 10-year could trade between, I would say that between 7 to 7.25 in the near term. And depending upon how the government borrowing program is progressing, if RBI is coming to support the market by way of open market operation or operation twist, it would depend. If there is no support from RBI, we could see them moving beyond 7.25 also in the near term. So that's where we see a distance. And corporate bond in next 3 to 6 months, in line with the G6. If the G6 move up by 20 basis more going from here, we could see the corporate bonds moving up by another 20 basis. Maybe slightly less, but another 10 to 15 basis.
Okay. So Yeah, the next question is, in the current scenario, how are we running the corporate bond fund and the money market fund?
Yeah. See, I will answer the money market fund. See, money market fund, we had this view, in fact, in the last policy also, that RBI will start normalizing. So there we have kept a very low, I would say, maturity compared to the peers. So there, because we understood that, sooner or later this is going to happen. So we have invested in a short, very, very short maturity papers. So obviously there we are going to benefit because, the mark to market losses today would be less compared to others. And we would immediately reprice, at a high yield. So that's going to benefit. So that has really worked out in our favor. And the corporate bond fund, again, as I mentioned, what we did was that we have invested in and around average duration is 2 years. So because 2 years, what it means is that because the curve, if you see, it is very steep from 2 year to 6 years. So from repo today, 2026 paper, it is just a 4 year paper. GSEC is trading at around 630. So that's a steepness. So obviously this steepness, benefits us in terms of the higher accrual without taking much risk. So we have invested in this part of the curve to take advantage of that. And I think we'll continue with this stance till we see that liquidity has actually started tightening or the curve starts flattening out. So till then we'll continue this policy so that it gives me a better return rather than staying in cash and thinking that, because yields are going up, then because I should stay in cash.
Okay. Yeah. So the next question is that US Fed hiked the rate sometime back. Now, the thought process is that US Fed will be hiking the rates aggressively. So will RBI rate hike be correlated to US, or will there be some kind of a deviation?
Yeah. So when I was explaining the policy, as I said, the Fed minutes itself has highlighted a faster pace of rate hike. In fact, markets have already built in when they meet in, I think, May, 50 basis rate hike. So it's already 0 to 0.25. It would be 0 to 0.75 already there. So that's how, and run down the balance sheet. Now that is a very, very fast pace. RBI has also started the normalizing the policy and hinted towards managing inflation more. So yes, as and when incoming data demands, RBI would also act. So that's what we believe. But not necessarily because Fed is hiked today, so tomorrow RBI has to hike. So RBI will take its own decision based on the incoming data.
Okay. So the next question, yeah, slightly different. It asks, did RBI mention anything about cryptocurrencies?
No, it is not a part of MPC, so they have not mentioned. So generally, these are discussed in the what I would say in press conference, but that is not part of the policy.
Okay, so I guess no more questions we have. We'll just wait for a minute and see. Yeah, so we don't have any more questions.
Yeah.
Yeah. Okay.
Okay. Thank you.
Thank you, everyone. Thank you for
Thank you.
joining. Thank you for taking out your
Thank you.
time.
Bye.
Thank you.
Bye. Bye.
Bye.
Yeah. Thank you.
Recording stopped.